Hey everyone, welcome to the next episode of The Vault, the BitGo podcast. My name is Mike Gross. I am a product marketer handling all things stablecoins here at BitGo, and I'm very excited to be here with my guest, Chuk Okpalugo. Thank you. Thank you for being here. Welcome.
Thank you. Thank you for having me. Yeah, excited to be here in this illustrious venue to talk about the evolution of finance. So it's awesome.
Great. You have become kind of the stablecoin pillar, stablecoin and payments pillar out in the industry. So I know you have spent some time in investment banking, private equity. You have an MBA from Harvard. You've got years working in product for various fintechs, including 4 years at Paxos. Now you are a prolific writer, a thought leader, a podcast host. You write the Stablecoin Blueprint, a newsletter. You write for This Week in FinTech, for, editor contributor, The Weekly Stable, and you also are the host of the Money Code podcast. So you're doing a lot of things. You have a very unique view of the stablecoin industry, of payments in general.
Yeah, no, it's perfect. And I think for anyone trying to figure out why is he doing so much, it's like I'm really spending time looking and exploring, building something in the space. And that's taking me down many different avenues of research. Where are the opportunities? What are the ways to drive value? Where does the value accrue, and so on? And the writing, the media is an outlet for all of that research. And so it just works out as a way to kind of get the thoughts out of my head. And I think writing is the best form of thinking. And I just decide to share that with other folks. And if they read it, great.
And a lot of people are reading it.
Oh, so, yeah, very fortunate. And the best thing about it is, I guess, whenever I'm wrong, I get corrected. And so it's the fastest path to the truth. You know, I write my thoughts out there, and then immediately lots of folks will go like, well, actually, it works like this. Here's a different example. And it's just been a really great way to network. So thank you to all the folks who have been active and engaged.
Definitely. And also check out his stuff if you get a chance. So I just wanted, let's dive into stablecoins. In the news every day, multiple times a day.
Yeah.
So I think maybe we'll start out with this. How are we seeing stablecoins used today? And who's using them?
Yeah. And as most folks know, and why this has all been very surprising and in more recently, stablecoins' main use case is trading, and it still is trading, and it has been since the kind of genesis, where initially it was a hedge against the volatile crypto assets, and folks needed a place on chain to have a stable store of value. The dollars being the global reserve currency, the most used as a reference asset, meant it was the perfect first choice for the stable asset on chain. Now, because of the path dependency that trading and trading use cases has driven, i.e., you have exchanges with liquidity, you have wallet infrastructure, you have applications all built around trading, you then have this proliferation of easier access to this asset. And therefore, the kind of next use case beyond a stable asset for trading was a stable asset for just everyday usage. Now, the places where that has been the most active has been places where, in the same way with that, crypto is volatile, so you need a stable asset for crypto. Where you have volatile currencies or volatile economies, you need a stable asset for those currencies. And US dollar is that asset, has been in these economies for a long time. Euro dollars are sitting at 13 trillion in market cap, in the supply. And there are many dollarized economies already before stablecoins were a thing. I think Argentina is a great example where Argentina is the largest holder of US dollars cash outside of the US. And there are many other examples of that. And so stablecoins, the main use case outside of trading is this access to the dollar. You can see that, and you can imagine that that is the most seen in areas where the demand for the dollar versus the access and ability to access it is greatest. And that tends to be in emerging markets and volatile economies. Now, once you have many folks holding these assets and trading liquidity and all the infrastructure of exchanges and market makers, you then start to have an emergent network for payments. And so that could be, you want to pay somebody in Argentina, well, now you can actually pay them in stablecoins. And that expands beyond just paying one person to, hey, actually, if sufficient parties around the world have access to exchanges with a stablecoin on one side and a local currency on the other, then you can already start to form this network where you can move money around with stablecoins in between. And that's often called the stablecoin sandwich. But in general, this ability to move dollars around and move value around the world, because blockchains and stablecoins are 24/7, instant, low cost, and permissionless, means that cross-border payments has been one of the fastest growing new use cases after global dollar access. So, bit of a long answer there.
No,
So that's the kind of the history. Starts with trading. It's still mostly trading, but we're seeing these emerging use cases for global dollar access, often in the global south, and volatile economies, and then payments, particularly cross-border.
as a mental model, it's pretty easy to imagine, say I want to send you something that represents US dollar stablecoin, right? Like you want to send me, okay, I want to send this to my family in one of these emerging markets. Can you give us a mental model explaining why businesses, right? So outside of the individual, how can businesses, like why are stablecoins maybe better than cash? Why would they be better than better than fiat? Why for a business? What are the advantages there?
Yeah, so I think we just look at what the businesses are trying to do. Let's talk about the example we provided earlier, paying out your employees or contractors. If your employees are certain areas of the world, there could be very good solutions for you, and you plug into that. Do what is already best for your business. Some of those locations, particularly in certain emerging markets, it's expensive, or it takes time. And so in certain markets, I want to emphasize it's not a stablecoins are not one size fits all. It's dependent on the corridor, on the size of the transaction, on what your recipient is comfortable with. But in certain cases, the recipient wants to hold stablecoins. So great, as a business, hey, I want to pay out my employees in the way that they want to receive it. Great, stablecoins are a great option. That's driven by the fact that they were already holding stablecoins. Or if the recipient wants to hold local currency in fiat, stablecoins may be a more efficient path of transferring value, in which case the provider of the transfer service may be utilizing stablecoins in the background, but the businesses doesn't need to be any the wiser. They just say, hey, I want to send money to Mexico or to Nigeria or to Southeast Asia. And the provider says, hey, yes, my competitor takes 3 days and charges you, 100 basis points. I'm going to do it in 1 hour and charge you less. And they don't necessarily need to say that they're using stablecoins, but the end result for the business is a faster payment. So I would treat that as one other example. And then if you're receiving payments for selling goods, particularly digital goods online, then you're essentially you can expand the range of customers who can purchase from you. Yes, ideally, if the folks already have a debit and credit cards and are connected to all the rest of the networks, sure. And in different regions, some people use more QR codes and local wallets, but stablecoins are a global network, and we're seeing, I think Stripe has released a lot of information on this, on how their merchants that added stablecoin acceptance saw new customers from countries that they were not getting as much payments from before, and some of those payments were much larger. And so you can imagine, a good example is if you're a Nigerian consumer, your debit and credit card doesn't have a high acceptance rates at US merchants. There are multiple reasons for that. We don't need to go into the details, but it's a lot easier for you to then actually pay for your online digital goods, call it like a vibe coding software or online subscription with stablecoins directly, than not have access because because the reasons I mentioned earlier, but the issuing banks don't have access to dollars, VAT of gray lists, and a long list of other reasons. So those are those initial things: paying out, faster cross-border payments, faster treasury if you're a multinational company, and accepting payments from more countries.
Up right now, we have 300 billion in market cap, give or take. The volumes are extremely high. Is the path to real adoption is it through like the end consumer? Like you were saying, like, okay, maybe the end consumer doesn't need to know that they're touching a stable coin because everything's happening on the back end with the payment provider or whoever else is dealing with it. Maybe it's not tomorrow, but that eventually, right, that we are going to see that the true adoption of a stable coin or of multiple stablecoins is going to be on this back end, right? Or is it going to be that consumers are saying, hey, I actually want to hold this exact stablecoin for this reason, for whatever it may be?
Payments is such a huge market, consumer finance, business finance. And so you have to break it down. I think the short answer is there's a lot of plumbing that will be built on this new technology that will be invisible to most people, but it'll drive a lot of volume. To break that down even further and go to the details, you have to look at each use case. I think corporate treasury for multinational businesses, corporate treasury for multinational payment firms drives currently faces a lot of problems with cross-border payments. So there's a huge opportunity there, and a lot of global payment flow runs across those companies. And so the end consumer may not necessarily see that their services are cheaper or the cost is cheaper or why it's cheaper. They'll just have a better service. Having said that, I think eventually you will see more financial applications that are built using blockchain technology, but not necessarily making that front and center. And I think that is a one way to phrase that is kind of banking as a service 2.0. So instead of fintechs building great, pretty UXs built on top of sponsor banks that are still plugged into slow ACH and wires, you can create similar, if not better, user experiences on blockchain rails where the benefits are much more control, much higher take rate of the kind of the yields generated. You can scale to multiple countries much faster because of the concept of self-custody and the current regulatory arbitrage of what that means for consumer protection and the UX benefits of that, or the UX benefits and drawbacks of that. But there are, I'm expecting and looking forward to just a lot more innovation in consumer finance and business finance from folks who are creating a hybrid where they're utilizing both blockchain where it's valuable and connecting to kind of responsible KYC'd and compliant partners for connectivity to traditional rails.
What about stablecoins that are not USD denominated? So, right, there's obviously a lot of other currencies, fiat currencies in the world. Will we see those come into play? Right now, I think it's 99% of all stablecoins are backed by US dollar denominated assets. What will be the impetus to kind of branch that out?
Yeah, I think it'll happen eventually, but it'll take a long time. These things take time to develop. And the reason for that is today, there is even before stablecoins, there was a demand for dollars from folks who are outside the US and they struggle to get access to the dollars. And stablecoins essentially made it easier for them to do what they were already trying to do. Now, the same is true to a lesser extent for other currencies. So I think the next country after the US with the largest foreign ownership of their cash is, well, the Eurozone. And then you can kind of go down the list. And so that's one place to start. But then there are other benefits where I was talking about banking as a service 2.0, where, the US has this history of sponsor banks with great APIs and you can build on top, same in the UK, like Revolut, Chime, and many other services are built on top of banks. And then until they get their own license. And not all countries have that, that equivalency. And so you may see opportunities where folks want to make domestic applications built on blockchains. However, I think that's a bit further out. And also it requires strong local stablecoin legislation in a way that is managing the tricky situation around stablecoins and local banking systems. Now, we're already seeing that in the US, where there's pushback from the banking lobby about how much stablecoins pay in yield because there's a threat of deposits. You essentially, if more and more deposits move into this kind of non-custodial nature or go to tech firms, then are you limiting the central bank's ability to manage monetary policy? That same argument is going to continue to happen in local regions. And so how that plays out in an environment where it's different from the US that has this very strong political push to make these things happen still remains to be seen. And then I guess the final element is cross-border payments. And we mentioned cross-border payments and treasury, and I think there are opportunities there for kind of wallet-based architecture. What I mean by that is, if you're a multinational company, you have multiple countries, multiple entities, multiple bank accounts, and it's very, very challenging to know where your money is, where's money coming in, where's the business needs to go out. I've got intercompany agreements. I'm managing FX risk. Got 100 different portals to manage. Now, with blockchains and local currency stablecoins, you can hold the right amounts of currency in wallets that are owned by each entity without having it being spread out across multiple different portals and bank accounts. It can be automated. You can use an AI eventually to really streamline the job of a CFO and a treasurer. That is a huge opportunity. Part of that relies on there being local currency stablecoins. I think that is a good source of demand. But for all those things to happen, there's a lot of different things that need to come true. And net finance is payments is a network, and these networks are hard to build and need the liquidity and the providers. This is all going to happen bit by bit, and so all of that is to say is theoretically the opportunity seems clear, but the path to get there is challenged with a range of different things. But because of the benefits on the other side are so strong, I think in 10 years or so, 5 to 10 years, we'll start to see meaningful non-US dollar stablecoins. So we'll say it's faster, but let's see. It could be faster, could be wrong there. But I think all those things that I mentioned, the political kind of challenge of doing these things, the lack of demand for local currency stablecoins by foreign currencies, the strength of local real-time payment rails, all these things limit the demand. But I think eventually, as folks move on to this new technology and more of these kind of dependencies are solved, we'll get there.
Yeah, obviously changing financial systems is it's not an overnight task. So it makes total sense. Actually, I wanted to touch on something you brought up, and that was the fear of deposit flight from big banks, right? Because if, for example, say there is a stable coin that does offer some kind of yield or interest reward, whatever you want to call it, there have been plenty of stories about the fear that may pull deposits away from U.S. banks. On the flip side of that, we see JP Morgan, for example, launching JPMD, which is a tokenized deposit token, which is also on a public blockchain, that's a whole other discussion. Okay, one, what is the difference between a stable coin and a tokenized deposit? And two, what's the advantage of a tokenized deposit over a stable coin?
Sure. In terms of the difference, they're both tokenized liabilities, and they both have controls as to who can hold it and where it can be sent to. But they differ on those two axes. Whose liabilities? So for a stablecoin, the liabilities is of the reserve fund at the issuer. And so, whether it's Tether, Circle, Paxos, or BitGo, and so on, what is the reserves backed by, and what happens in stress, and what could that stress look like? And you can do, risk analysis and say, if it's 100% backed by cash and high quality liquid assets in various stress scenarios, what happens? Bank for tokenized deposits is a commercial bank liability. Again, you can do the same stress activity. Banks have a different liability and a haircut mechanism. This FDIC insurance, sure, but it's still a commercial bank. So for the largest commercial banks like JP Morgan that are too big to fail, you'll probably feel quite comfortable with that liability. For the small ones, probably less comfortable. Same for issuers. An issuer that you never heard of that doesn't have attestations, that have shady founders, you're probably not going to feel comfortable. Versus another one that is well attested, trusted by lots of others, audited by well-known firms, and so on. And so there are similarities and differences there, but it's the nature of the liability is one. Then in terms of how it can be transferred, so far the tokenized deposits that are liabilities of banks, we've seen there's no single definition, but what we've seen so far is the banks will only allow the transfer of that liability to other customers of the bank. Right. Now, banks like JP Morgan have such large networks that's a very busy network here. But that means that it's not set to solve problems where you need permissionless transfer, or the customers are the bank. And there are many questions as to how do you have interoperability between different banks, tokenized liabilities, and so on, for another time. But those are the kind of the key differences. And so where would I think if you are in a kind of cross-border payments network where you are other banks, call it, think of like a replacement to the correspondent banking system, or other kind of wholesale payments where very large institutions, they're all already customers of JP Morgan. That's probably a good opportunity for a tokenized deposit, where it fits in already with your systems today. You don't necessarily need to think through or manage the risk of a net new issuer, and you're already a customer. I think where it fails, or where stablecoins may do better, are in areas where you need permissionless networks. And so we're talking about emerging markets, we're talking about individuals and consumers, and corporations and firms that don't necessarily are all part of the same system. And so you can obviously see that that network is technically larger because it's everybody. But I think that if you are a leader in a financial institution and you're already working with JP Morgan, and all of your counterparties, or the counterparties that you care about, are working with JP Morgan, it may actually be a simpler integration. And really all you care about is faster, cheap, more efficient payments, and that are reconciled with the least change to your accounting team and your risk team's workflows. So I can see use cases that where tokenized deposits may be more advantageous. They don't solve the permissionless open money problem, but that's not a problem that everyone has.
We are almost out of time, so I just want to quickly ask you something about what you're excited about in the future. So like, what's as stablecoins, I mean, obviously we're going to keep hearing about them. They're going to keep evolving. As you're saying, we're 5-10 years, we're going to get non-USD denominated stablecoins. I read about agentic payments all the time, and how AI is kind of like, AI and stablecoins are almost this like perfect match for programmable money, programmable payments. What do you see there that it like is getting you excited?
Yeah, there's a lot of talk going on with agentic payments. I think it's the one area that is, if not equally, maybe more overhyped than stablecoins themselves. Because I think we can all intuitively see that, hey, when I shop, I have an intent to get the thing that I want. I don't necessarily want to have to go through those different processes. To the extent that you can imagine a personal shopper or a personal assistant do something for you. I can easily see an agent, if sufficiently talented agent, doing the same thing. Now, how will that agent pay? Now, that's a big question. And I think I just mentioned commerce that was driven by my intent, in which case, me personally, or maybe for others, you may still want to have a checkpoint, you may want to have some kind of limitation, but there's lots of other commerce outside of that area. And I think as we give agents more and more agency, and you say, hey, here's a budget to go solve this thing, or hey, you're actually running, it's actually not buying something for me, it is a system, and the system needs to call other services, and those services have cost. And instead of it being subscription, it is pay per use. Okay, then how should we pay per use? Well, we can figure out a way to use Visa, MasterCard, and plug it in, or I can sign up to that service ahead of time, prepay, and have credits. These are all formats that we have today. But in certain scenarios where I don't want to have to sign up ahead of time, I don't want to have to prepay because I don't use it all, but I still want to use your service, it would be nice, and conceivably this is a clear use case, to just pay for what I need without having to sign up. And I think that's not quite possible today because of just the way that payment systems work. You can build that, but if you build that, you need everyone to join that system. And so how do you create an open system where people can pay each other without prepaying, without signing up, without API keys, and without credit cards details? That is one problem that kind of machine-to-machine agentic payment use cases, that's a problem that exists in that use case, machine-to-machine payments. And X402, I think it's a protocol by Coinbase that essentially uses the HTTP request, the internet request of, hey, I want to use your resource. Your resource says, hey, here's the web page. That's how web pages work. In this case, the web page can say, yes, but to access this web page, you need to pay. And I don't need to know anything about you, who you are, credit card details. I don't need credits. I don't need anything else. Here's how you pay. Now that conceivably makes sense. And it's just yet to see the use cases that have with traction where people are putting together machine to machine payments on a pay per use basis. But I think it'll happen. So that's I'm excited about seeing that play out. Um, I have on my to-do list, I want to like agentify my workflows a lot more. And then and as I've been doing that, there are agent workflow marketplaces where you can kind of buy a workflow, and then every time you use the workflow, you pay. But these are unclosed systems, and you sign up with credit card. I can imagine a lot of this stuff happening in an open way with smart contracts, and smart contracts just enable a permissionless, verifiable logic that says, "Hey, if you use this thing, every time you use this thing, I get paid a tenth of a tenth of a tenth of a cent." Cool. Conceivably, it makes sense. Yeah. No one's cracked it yet, but lots of people are working on it, and so I wouldn't be surprised uh, for that to be rapidly growing. So far, the hype is here and the traction is here, of course. But I'm excited for it, to be honest.
And I like you said, you need to give the agents more agency.
Yeah, honestly, like right now, I don't know how much you played around with agents and so on. They're still okay, not great, but the promise is there, and it's moving so quickly. Where's the puck going? The puck is going to agent systems that are as competent as personal systems, for sure. It's going to happen. I don't know when. Whoever builds that is going to be very wealthy. I will buy that product, right? I'm doing already too many things I need. I'd love to have strong assistance. But from a payment perspective, for most things that I'm triggering, I'm happy to use my card, and especially because I know that I have recourse. If something happens, I go to the service, or I go to Amex or Chase and say, I don't authorize this, or I want to do reverse. And especially for kind of online products where I'm not using it, the merchant didn't lose out. It's not like I took the product away from them and consumed it. Like, you didn't lose out, no one lost out. I just want to reverse it. And so I think there will be use cases where Visa, MasterCard aren't the solution. I can conceive of them. None of them have grown yet.
I mean, it's exciting. We'll see.
Yes.
Awesome. Great. Well, thank you so much for being here. It's been awesome conversation. You're a wealth of knowledge. And thank you for your time today.
Thank you for having me. Happy to kind of keep the conversation going, either online, on various other platforms. There's just so much to dig into with this topic, and it affects so many parts of the industry: payments, banking, finance, credit, capital markets, that people should be paying attention.
Definitely. Yeah. And if you haven't, check out Chuck's work. It's on X, LinkedIn, on all the the places you listed your podcasts. So thank you again.
Awesome. Great. Thanks for having me. Thanks. Good to see you.